Hi guys, just a quick not weekend review, but more of a week look ahead. I didn't get to do a lot of reviews last week, but I trust that your understanding of overnight session, you were able to do your own reviews. This week should have more daily reviews, and yeah, let's jump into it. So let's start off with most important thing, identifying where the market is coming from, or better yet, where the delivery started. It's essentially the same thing worded two different ways, right? So for me, based on how I view price, this candle is the start of the delivery here. So this is called an engineered origin, which means the opening price of this candle is going to be very important. Said it in many videos before, so no surprise there. Which means since the start of this delivery, as the market moves forward, this is not candle counting, right? Just saying that, yeah. As the market moves forward, you're essentially trying to watch how the market is delivered. Between right here, this day in time, and right here, we could see how the range was created, let's say from here all the way down to here. Inside that range, there is no down candles right here to right here. No down candle body, right? If there's no down candle body right here, that means that this is inefficient. This portion of price is inefficient. So as long as price remains below that green box, we will expect something to cause a buy side delivery that trades through here and then a down candle gets printed here. Okay. That didn't happen until here, right here, which means as we deliver price, we generally expect price to be running on buy side and sell side and all that good stuff. But when something like this is painstakingly obvious, making that the draw on liquidity, it means that's the delivery objective. Once we hit that, the delivery is complete. Here, right? Just so we're clear. The objective is not to trade through here. The objective is to print a down candle here, which means between right here and right here, that's a delivery cycle. No need to count any candles inside here and all that madness, right? Just saying that's a delivery cycle. It ends there, which means the next delivery cycle starts here. All right. So if this is the next delivery cycle, what's important about this? Good question. It means the previous range is here. There. High and low of the previous delivery, right? That's the range. This is the same as previous day's range, previous hours range, overnight session range, etc., etc., etc. This is the start of the new delivery. Since this delivery is starting inside a previously efficiently traded price range, as long as we're trading lower, what's the market seeking? Not a fair value gap. Caught you, didn't I? This is already efficient, which means if this is efficient, the market seeks fair value, not a fair value gap. Fair value is the same as average pricing. What do you find average price? High, low, 50%. There we go. Now, 50% by itself is not a PDRA. It's not, right? 50% just tells you where to look to find the PDRA. So in the most simplistic forms, if we put a horizontal line here and say that's 50%, what would I want to see here? Something that contributes to the current order flow. If the order flow is bullish, and it's been relatively bullish because all of these madness didn't show any intent of trading lower. This is all reaccumulation, price dipping below lows to grab liquidity and then running away. No real expansion below the lows, right? So if this is an efficiently traded range and I'm looking for something below 50% of the range, that automatically means I'm looking for a discount array. Have to be. So what's below here, 50%, that I could use as a reference point to anticipate the next reaction or where the next key level is going to be. Opening price. This is the same as a weekly opening price. If you had a weekly range right here and it was delivered like that, and next week open inside that range, you could use the same thing, same idea. It's the same conceptual idea. So my PD array, firstly, is the opening price right here. I have down candles, take lows, all that good stuff. I could refine the lower time frame for precision, but in the most simplistic form, this is what I would want to see. Okay. I didn't trade this. I would I couldn't mentally be a part of the market because of some personal stuff. Right? Life is happening. But because I've already pointed to this specific candle and the fact that this is the start of the delivery, hey, hindsight as much, yeah. This is what the direction is, right? Now let's talk about let's push this line away and focus now on that one. Let's take this off. Do some hindsight analysis for the coming week. It's a joke, by the way. This is not anything else but that. So for the new delivery that started right now, this is the current range that we have. Low of the range, high of the range, right there. 50% of my range is there. What's important about this? Nothing. Absolutely nothing, because the range is inefficient. Since the start of the delivery here, we had sell side, efficient, inefficient. All this is inefficient. Okay. So if I go to a lower time frame and I want to refine this based on time of day, I would essentially be looking at the delivery between this red line and the high right there for, I don't know, something that we could target as a retracement, because this is inefficient and retracement seek inefficiencies. So let's play H1. This is my range. Okay, cool. So this is the start of it. There's my range. This would be the start of it. Let's play devil's advocate. Say that's the start of it and move this all the way over to here. That's my range. What can I say about my range? Inefficiency, filled, new delivery, right there. This retracement now on this time frame is suggesting that we have an efficient range right here and the market is trading lower to seek the imbalances right here. Okay. This to me, since the higher time frame is inefficient and the lower time frame is efficient, this is internal liquidity. So to put it simply, I would look for between now and Wednesday at 4 a.m. Scoot, 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 scoot. Here. Something that leads price down here to reaccumulate. I don't care. I don't know what they want to do here, but there's no news Monday and Tuesday. So this is going to be sentiment driven. Friday was a large range day, I think. Yeah, Friday was a large range day. So expect choppy market conditions here. Choppy markets in an efficient range means holding patterns. So allow for this to do whatever it wants to do here. For trading opportunities, then we're going to look at overnight session runs on liquidity. That's it. So that's what you want to look for. This is the range. Anything outside of this range, I would expect to be a liquidity grab on the downside, because the order flow is suggesting that we need to trade higher to fill the numbers. So I'm looking at 13,350 I'll show you from a daily chart. Um, this is a CFD chart. Futures chart may vary. I'm looking at this candle up here. This one, August 18th. I'm looking for us to try to get back into that range. So the low on that is about 390 something, I believe, if I remember correctly. There. So roughly about 13.4. So if you're in my Telegram channel, you remember last week when this madness was happening, I said 13,350 to 13,400, or I'm not interested. So this is me not being interested in this and waiting for the next quote unquote key level to be hit before I get interested. This retracement down to set up the run is what I expect. Going into this day, Monday the 15th, I would expect trade down, then a run up. After this day, we pivot, and then I start seeing downside again. Okay. So all in all, that's pretty much it